Legendary investor Chris Hohn has been outperforming the market for more than 2 decades with a performance above 18% per year. Comparatively, the S&P 500 has been doing like 10% per year. So that's a 8% alpha every year for 20 years. The outperformance is huge. In this video, we are going to talk about his specific strategy, specific stock picks, and how you can clone this legendary investor so you can have the same results. Because we learned recently that his fund, TCI, broke the hedge fund profit record last year because of a great performance in 2025. So if you go on Twitter right now, you may see many articles written about Chris Hohn. They own up to $1 trillion in assets. They have a fund that was founded in 2004 and plenty of new articles about this amazing performance in 2025. This has been a beautiful run for Chris Hohn, and I have a couple of things I want to share with you. His portfolio, what he has shared in interview, and how he looks for golden opportunities for his portfolio. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And the way I learned investing was by reading what the legendary investors have written, what they wrote, what they said in interviews. I just consumed all this information. So of course, Chris Hohn has been an inspiration from my own portfolio, and I like to see his performance going. He is not going to retire soon, and he is doing some interviews. This is his portfolio right now. What you can see in this portfolio is that the stocks he has are old. The majority of his portfolio is filled with companies that were established in 1917, 1905, 1958, etc., etc., etc. You don't have young companies. You don't have tech startups. This is a key differentiator between him and other investors. If you look at all the big hedge funds, or if you look at the portfolios of retail investors, they are always looking after the next big thing. What will be the next big startup company? What will be the next giant? What will be the golden opportunity of tomorrow with robotics, with AI, etc., etc., etc. And here you are with an amazing performance, a legendary investor, somebody that only focuses on old companies. Because if he's doing this, it's for a reason. He's investing in old companies because they have survived many cycles. They have survived many recessions. And if they have survived and thrived during all these recessions, maybe it's for a reason. Maybe because they are unkillable. And it's exactly the pitch of his portfolio. He's only investing in companies that can't be destroyed by capitalism because of a moat, because he invests in monopoly. So now a little bit of history for Chris Hohn. Maybe some of you don't know who he is. In the past, he did a lot of activism before 2008, and then he completely changed his strategy, okay? And what I want to show you is an interview, the kind of stocks he wants in his portfolio, from Kevin G here on Twitter. Chris Hohn on the secret to his outperformance, 9% above market for 20 plus years. As I told you, the market did 10% per year, and he did 18, 19% per year. So here is an extract from an interview. I will read it for you. Well, our strategy has been to invest in great companies, but over time, I've come to refine and understand better what that means. Because he only invests in quality companies, as we can see here. By the way, some of these companies are well known, some of these companies are hidden, and we'll talk about this later on this video, because there is a reason why. But that's just point one, find great companies. Point two is being concentrated. As George Soros said once, it doesn't matter if you're right or wrong. All that matters is how big you are, your position size when you're right, and your position size when you're wrong. If I'm right on a 1% position, it kind of doesn't make any sense. So we'll take positions of 10, 15% of the portfolio. In the past, even 25% of the fund. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. If you look at his portfolio, he invests in 14, 15, maybe 14 companies here. So we are talking about a very concentrated portfolio. He doesn't like diversification. For all of the retail investors that praise diversification, diversification is great if you don't know what you're doing. If you know what you're doing, it doesn't make any sense. It makes sense to focus your best bets on your best opportunities where you have the most amount of conviction because you know what you're doing. Okay? If you want to be stock picking, of course. And that's a double-edged sword if you're right. It's fantastic. If you're wrong, it's very painful. So concentration is an important facet, but because there aren't hundreds of great ideas and companies. And you might say, that sounds risky, then it is. And then I would ask you, well, how do you define risk? And the best definition of that was, for me, given by Warren Buffett, who we all love. And he defined risk as not knowing what you're doing. And then the third component I would say is long-termism. You can find a great company, but if your time horizon is very short, what Keynes called the voting machine, he said, in the short term, the market is a voting machine, and in the long term, it's a weighing machine. Well, this is very true in the short term. In the short term, anything is possible, right? And going back to Warren Buffett, he was asked, was Coca-Cola a risky investment when he first made it? And he said, depend on the time horizon. I think when Warren Buffett bought Coca-Cola, it was a huge part of his portfolio. So some people argued it was risky because the potential for Coca-Cola was tapped. The potential was tapped. Guess what? They continue to increase the prices of their cans. They continue to increase volume. So if you go back in history, many times Coca-Cola was doubted. You have a great article in 1921, I think, explaining how Coca-Cola was saturated already and the potential was capped. Well, guess what? It was 100 years ago, and the potential was not capped at all. Depending on the time horizon, over 1 year, 1 month, very risky. He couldn't sell where the price would trade at. It doesn't necessarily reflect fundamentals in the short or even medium term. And so I do think time horizon is a critical thing. That also comes back to this point of always investing in old companies. You don't want to trade in and out of stocks that are recent. That's too speculative. That's not the kind of games he's playing. And even intelligent investors are unable or unwilling to have a long-term horizon. And I would put engagement as another component of that for us, of adding value. So find the great companies, focused or concentrated portfolio, long-termism and engagement. Act as an owner in simple terms. But a lot of investors get confused that the thing you want is growth. If you look at industries like airlines, they've been growing for 100 years, maybe 5% per year. Fantastic growth. But collectively and cumulatively, the industry never made any money because competition was too strong. Airlines have no moat. Many investors are saying the same thing. For people to choose a plane, they choose for a good time, depending, you don't want to take a plane at 2 a.m., right? They look for a good price, and you want a plane that is fast. You don't care of the brand. For normal airlines, people don't care. They want efficiency, good price, good timing, it's convenient, go for it. For luxury airlines, it's different. People will choose Emirates or Singapore Airlines because they have created this brand, this luxury brand. But for most airlines, people go for time, efficiency, price. That's it. So you don't have any moat. People don't care whether you choose them or them another brand or another brand. It's the same for hotels. People choose hotels because they want good price, good location, good efficiency. You don't care if the name of the hotel is X or Y or Z. You don't care at all. And actually, you have some hotels that are differentiated because they are luxury. So the only way to have a moat in this hotel industry, in this airlines industry, is to be luxury. The same thing can be said also for cars. Efficiency, price, convenience, etc., etc., etc. So you have some industries that have no moat. So sometimes it's better to avoid specific industries. Avoid industries where you have too much competition because they will eat each other inside this industry and it's not good for your long-term results. Sometimes it's better to completely avoid industries and focus on industries where you have monopolies, strong moat businesses. And so growth per se, growth by itself is not a guarantee of making money. So you need critically barriers to entry to competition and sustainable value add and high value add. So it's actually a combination of barriers to entry and high value added that you can charge for. And of course, then growth has a value. So everybody would agree with those statements. But the interesting thing is, going back again a third time to Warren Buffett, he said most moats aren't worth a damn because you think you've got a moat and then it erodes. So the real thing is sustainability of moats. And this is my point number one. He is investing in companies that are 100 years old. So you have sustainability of moat. The title of this video is how Chris Hohn has been outperforming or something like this. A key element he invests in companies with a moat, with a competitive advantage, but not a recent one. He wants long duration moats that have been sustainable for decades and decades and decades and decades. They have survived many decades of recessions, many decades of crises. All their industries collapsed and then rebounded and collapsed and rebounded. And these companies are still standing because they have such a wide moat. And you don't have many opportunities in the world, many companies in the world that fit this criteria, okay? Yes, now, next point I want to share with you is this. Again, from the same Twitter account, Chris Hohn on why investing in the long term is a real advantage and actually a free lunch. You mentioned long-term themes, Chris. Is this approach that Christian takes on investing in long-term structure themes something that resonates with you? Yeah, the average life of a holding of our current portfolio is 8 years. When he buys a stock, he owns for, on average, 8 years. Now you can compare with your own portfolio and you can ask the same question. How long do you hold your stocks? For how long? If you've been investing for many years, you can have a good idea of your turnaround. Is it around 8 years? Well, it depends on you. Now, the average holding of a US stock is less than 1 year. On average, US stockholders own stocks for a couple of months. And you have this big trend of stock ownership duration that is going down and down and down and down for the past decades and decades and decades, because people have access to more data. You have less friction in the world. If you want to buy and sell stocks, you can do it in one click right now. It's easy, it's tempting. You have a gamification of the game with Robinhood. People see green, people see red, people have leverage. It's fun. People do less gambling now. The new gambling is the stock market. So you have a lot of temptations to trade the market. So the average holding in the US economy is just very short right now, a couple of months. So very short term, which means on average, people are short term. Long-term investors are the minority of the market. So investors are absolutely en masse shorter trading oriented. So we should ask, why is long-termism a good strategy? Well, we should ask the question why. I always say justify. And if you look empirically, it turns out that the very best companies, high return on equity, they stay good. They don't disappear overnight generally. And bad companies stay bad. Low return on equity stay low return on equity. So you have a great chart that Terry Smith from Fundsmith shares. It's the return on invested capital per industry. How can I show you? Fundsmith, ROIC industries. I can show you a chart that explains his point wonderfully. And I think this is the good chart. median and actual ROIC. This is this one. What you can see here, how can I show you? This one is in good shape. Let me click on this one. You have specific industries that are known to be efficient with a lot of return on invested capital, return on equity. I can zoom in so you see better. Anyway, maybe that's a little bit blurred because I'm too zoomed in, but you will understand my point. Return on invested capital for industries is stable. Industries with poor returns remain poor industries over time. Being cheap or lowly rated does not make them good companies. So you can slide your head like this, and you can see the different industries here. And for all these industries, in red, this is your return on invested capital. It's an efficiency measure during this period, 1963 to 2004. And then you have a line in gray for the same industries, for each industry, from this period between 1995 and 2004. What you can see here is, in the past, industries that were efficient stay efficient. And in the past, companies that were not efficient at all, with a very low ROIC, they did not magically become efficient. Why? Because of nature of markets. Some industries are very competitive. Chris Hohn just talked about airlines, for example. And some industries are very efficient. They stay efficient. Tobacco companies, very efficient. Oil companies, oil and gas companies, not efficient at all, because they are cyclical, because you have many competitive pressures. And what Chris Hohn wants to focus his fund on is this, just the left part of this chart. Companies that have always been efficient, that will always stay efficient, most likely, because they are different. They have a great moat that they can sustain over time. I totally agree. We have an expression, good companies are better than they seem. Bad companies are worse than they seem. You got to get rid of the bad ones and just double down on the good ones. You can check the ROIC, the return on invested capital, for all of each of these companies, by the way, in his portfolio. You will see that we are talking about very efficient companies here. Yeah, there is persistency, and the value of that company is only seen over the long term. So they say there is no free lunch in finance, but actually I do think long-termism in a great company is a free lunch. Because if you look at any sell-side model, they will go out 3 years, 2 years. Why? Because that's the time horizon of the typical buy-side investor, 1 or 2 years. This is true. I've seen this firsthand when I was working in investment funds. People try to make a DCF, a forecast, and they try to forecast 1 year, 2 years, 3 years, and after this, the analysis gets blurry. But guess what? A moat, a competitive advantage, can last for more than 3 years. A moat can last for 10 years, 20 years. You can check your portfolio right now and check your holdings, check your stocks, and ask yourself, how long will the moat last? If you talk about a startup company, maybe you don't know. Maybe you will say 1 or 2 years. And now if you talk about an airport, for example, you have a company that he owns, Aetna here. Airport in Spain. What is the duration of the moat? 1 year, 2 years? No, much longer than this. Long-term assets that have regulatory license to stay here in a monopolistic position, they have a very long duration of the moat. Okay. But what if it can keep being good for 30 years? Then you're completely undervaluing that company. And people don't look at it because most companies, 95% of companies, are mediocre or bad companies. Let me repeat in case that's not clear for you. 95% of companies are mediocre or bad companies. They meet their cost of capital, but they're not super companies. One of the companies I mentioned, aerospace, we invested in Safran, which is from France. We've owned it for 13 years now. We are actually one of the largest investors in the company, and we've made around 20% per year for 13 years. So long period duration, very long period. What company is that? Safran, there are a joint venture with GE Aerospace in aircraft engines. You have a couple of videos on YouTube that are talking about how wide the moat is for Safran. I highly recommend you watch these videos. And so we have investors who would come in and say, well, we want new things. Well, actually, new things, sometimes they work, sometimes they don't work. And Chris Hohn likes old things. Things that have been here and winning for decades and decades and decades. If you look at his portfolio right now, you will see some international investments. You will see that all the companies are old. And if you go to Twitter right now, you type Chris Hohn, you will see some people sharing the portfolio of Chris Hohn. I want my audience to be very careful about what I will say, because some data is wrong on the internet. Some people check on here. Let me show you Dataroma. Some people share the portfolio of Chris Hohn, but they only share the US holdings. So if you go to Dataroma, you can see the portfolio, TCI Fund Management, and you will only see the US holdings, the US companies. You will see that the first position is GE Aerospace, and then Visa, Microsoft, Moody's, S&P Global, Canadian Pacific, Alphabet, Canadian National Railways, and Ferrovial. Did I mention something? Did I forget something? Yes, I forgot AENA, the Spanish airport company, for example. Yes, you also forget Safran. So be extremely careful what you see on the internet. Dataroma is wrong. I mean, Dataroma only takes into account the US equities, but Chris Hohn is also invested in Europe, for example. You can see some companies, also Airbus from France, some companies are not in Dataroma. And some people on Twitter, you know what, I will not name names. Some people on Twitter share the portfolio, thinking good, but actually they forget all the international investments. You have to include the international investments. If you look at Dataroma right now, you look at his portfolio, Visa is considered to be 18% of his portfolio. That is wrong. GE Aerospace, 27% of his portfolio. It is wrong because you have to include international investments. So the split will be different. Okay? You can check. Some people do it the right way. Vinci, which is also from France. Here we go. This will be a better split, the weight of the portfolio. GE Aerospace is not 27% of his portfolio. It's 18%. Safran, that is non-existent on Dataroma because of the 13F. Safran is 14% of his portfolio. Visa is 12%. Moody's, etc., 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 etc. So if you really want to copy his portfolio, check the international investments. And then I believe his portfolio is a very good hunting ground. Now, what did we learn about Chris Hohn very recently? Maybe you want to copy his picks, something I would completely understand. He bought more Visa recently. He bought more Moody's. He bought more S&P Global. So maybe if you want to follow Chris Hohn and follow his outperformance, you can do some good research on Visa, Moody's, and S&P Global. These will be 3 very interesting stocks to buy now if you want to follow Chris Hohn. So you invest in quality companies, old companies with moats that are durable. You want to check the sustainability of the moat. You want to stay in monopolistic positions. You invest in monopolies, duopolies, things that can't be really disrupted by competitors. You want to be invested in companies with a high return on equity, return on invested capital. I don't personally like the return on equity because I think you can cheat. So I am using return on invested capital, the ROIC, as I showed you here with Fundsmith here. But I think if you look at the ROIC for all these companies, you will see great things. This is a very good hunting ground, and I believe Chris Hohn, with his strategy, will continue to outperform the market because nothing has changed for his strategy. You just invest in great companies because most of the time, great companies stay great. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.